Cash isn't trash anymore, but is it working hard enough for you? Welcome to Equity Mates Investing, a podcast where we explore what is possible in the world of investing. And today we are talking all things fixed income. Term deposits are rolling off, the RBA is holding firm, and your cash might not be working as hard as it could be. Today we are joined by Sam Watkins from PIMCO, and he's here to talk about Earn, their newest short-term active ETF, and why enhanced cash strategies matter right now. So without further ado, let's get stuck into this interview with Sam Watkins. Sam, welcome to Equity Mates.
Thank you, Alec and Bryce. Thanks for having me back.
Yes, I should have said welcome back to Equity Mates.
There we go. Now, I want to start by making a proposal here.
Oh, wow.
Okay. Tables turn.
Which is, I think you need to rebrand from Equity Mates to Bond Mates.
Oh, yeah. Okay.
I'm pretty sure when your colleague Adam was in recently, we went fixed income
Fixed
mates.
income.
There we go.
Fixed income
Okay.
friends.
Fixed income friends.
Okay,
Yeah.
I like that.
Make the pitch. Why should we
That,
rebrand?
that's got a ring to it. Well, we're about to go through, exactly that, and I think it's time of the market. It's very top of conversation at the moment.
Okay. Nice.
Well,
All right.
we will get into that. We will get into that.
Yeah.
But last time we had you on earlier in the year, Trump was just hitting his stride, and you just launched your first range of ETFs into the Australian market.
Those two things weren't related.
Not related, but it was just
Not
a
related.
lot. I remember we had a lot to discuss in that episode. Since then, how's the launch gone?
Well, I'm pleased there's been no tariffs announced on ETFs.
Yes.
Maybe we start there. But no, look.
Or podcasting.
Indeed. Look, it's been a great launch. It really has been. We've been very pleased with what's happened in the first 6 months. We're just over that now. And during that period with the 4 ETFs we've launched, all of them are trading above the issue price, which was $20 for all of them. All of them have delivered very strong yield, and most importantly, all of them have delivered very strong alpha above their benchmarks. And the alpha has been between 0.78% and 1.17% in absolute terms. So, given it's been 6 months, in a per annum sense, you can really double that in terms of the impact of the active management. So really strong outcome for investors, which we're very proud of.
Nice.
We had your colleague Adam on recently, a few episodes ago, and he really sort of demystified what it means to be a bond manager and sort of the day-to-day for how you operate. A lot of our audience are overweight equities. So what are, in your view, 3 reasons why we should consider fixed income in our portfolios?
So firstly, starting conditions are important. Most asset classes are priced to perfection at the moment. We've got equities sitting at all-time highs, both in terms of their valuation and in terms of the price multiple. And at the same time, spreads in a lot of risk assets, like high-yield bonds or private credit, are also looking pretty tight. So that's the first reason. So against that backdrop, we have a very compelling starting yield that's offered by the higher quality end of fixed income, where you start at 5 to 6%, and then there's an additional 1 to 1.5% of active management that we think makes that look very compelling on a relative sense. And then finally, what we would say is that the fact that we are now entering into a cutting cycle, what that is a very compelling time for people to be moving into this as an asset class, either being out of term deposits that are starting to now see lower levels of starting interest being proposed by banks, but also just in terms of that very compelling return aspect that drives the bond prices higher. When you buy a bond that has a high yield at that moment in time, if interest rates get cut, then everything reprices to that new, regime of yield. And so in order to get to the same price, the principal value must go up in value.
Yeah.
So, think of it as interest rates go down, bond prices go up.
So when we've last spoke, there were 4 active ETFs that you brought to market, or PIMCO brought to market. Now you're adding to that range, and there's a new one, the PIMCO Short-Term Active Yield ETF. The ticker is EARN. Always appreciate the tickers ETF providers manage to get. So I guess introduce us to this as a strategy, and also how it sort of complements the range of ETFs that you already have in market.
So the genesis for this fund has been something similar actually to the other 4 that we've launched, which has been about taking a strategy that has been tested in the institutional environment, has delivered very strong returns to that institutional client base, but has not, up until now, been available to end investors. So this new strategy that we've launched is actually an access point to one we've been running for many, many years for one of the largest institutions in Australia. That's the genesis as to why. And the why now, we're entering into a cutting cycle. And what that means is that the opportunities or options that are available for investors that they may have used up until now, those being term deposits or even just high yield bank accounts, those rates are starting to fall. And we've now seen those rates currently fall to around about 2.84% on a standard 6-month term deposit. And by comparison, the carry or the yield in the EARN ETF is sitting just above 4% at 4.18%. So it's a pretty material uplift. And when you compare the two, one of them is tradable on the stock exchange and is daily liquid by default, and the other, of course, locks you in for a 6-month period. So pretty compelling, pretty good time of the cycle to be thinking about things that lock in a rate for a longer period of time.
And just for people who are new to the fixed income world, when we talk about short term, like how short term are we talking?
The expectation is that we're going to have a duration, as we would call it, or term, which will range between 6 months and a year. So the portfolio is comprised of some things that are much shorter dated than that, and some things that might go out as far as 3 years, but ultimately with a portfolio where the average falls out in that 6 months to 1 year.
How should people be thinking about the different roles that these different active ETFs play in a portfolio?
So this would sit in a position which is much more closely aligned to a 6-month term deposit, a 12-month term deposit, whereas other ETFs that we have, such as the Global Bond Fund, the benchmark there has a duration which is closer to 7 years. So it ranges also between 5 and as high as 8.5 years. But think of that as being around about 7 years in duration. So quite different in terms of the maturity because they're ultimately looking to solve different problems. The Global Bond Fund is looking to lock in rates for a much longer period of time. And if we were to enter into an environment where growth was to become very challenged and central banks were to cut rates aggressively, having more duration or more term would mean that the impact on the bonds would be even greater when rates are cut. Rates go down, bonds go up. Where you have more term or duration, that factor is even stronger. So for those people looking to add a defensive allocation to their portfolio and lock in rates for much longer, that Global Bond Fund is a good alternative. But here, the EARN ETF is something that we're launching really to fit in that 6 to 12 month space, but still, of course, have the benefits of the listed liquidity.
I mean, it's a pretty interesting time. At the moment, we're seeing inflation ticking up. I think at the time of recording, the RBA has held rates. So how do you, or how should we think about EARN in the current interest rate cycle? What's sort of your views on the next sort of 6 to 12 months?
Yeah, look, I did get a chance to read the statement from the RBA just before coming down here and noted exactly as you did. Rates on hold today, and I would summarize it as being data dependent, is really the sort of the crux of what the message was from the RBA, and a mixed picture, a picture where underlying resilience of the economy is perhaps a little bit stronger than what it may have been in the lead up. And the inflation is declining more slowly, I think was the wording that was used. Along those lines. And so, broadly the picture is that perhaps that normalization is going to take a little bit longer. But we still think that the trajectory is that rates will move back towards neutral, which in Australia, we see neutral rates as sitting in that 2.5% to 3%. Somewhere in that zone is what we think the RBA neutral rate is. And so still a fair way to go. So I think what that would really translate through to is something in the order of 2 to 3 cuts. But we think it's going to be over a longer period of time. Quarterly is approximately the cadence.
Like
that
cut
be
each quarter.
Cut each quarter. But again, very data dependent. So going back to your question, though, of in this environment, how would Earn perform? How does that fit with the environment that we're launching it in? And firstly, I mentioned that the carry in the portfolio is materially above where interest rates are right now. So if rates were to not go down any further, you are in obviously a pretty solid position versus where other alternative rates are today. Secondly, if rates were to rise, you're in a position where you have a very meaningful buffer to where rates would have to rise before you were in a worse position. And more importantly, after 6 months, the whole thing resets and you're in a new interest rate environment. So you've got a fairly defensible position there, and one that you would expect that through time will deliver strong performance versus alternative investments.
Nice.
So let's dig into the ETF, Earn, and we often talk about yields in a fund and, or like a target above the RBA cash rate. I think Earn is trying to do 75 basis points to 125 basis points above the RBA cash rate. But I think it would be helpful to unpack like what are the underlying holdings, or like I know they'll change, but give us a sense of like some of the bond issuers that make up the ETF.
Firstly, the opportunity set is global, and the approach that's taken is to look for the best opportunity set that we see in Australia and in other regions when hedged back to Australian dollars. So a large part of the portfolio will be made up of government bonds, of some agency and semi-government bonds. So think of those as being, of course, state governments of Australia, of course, the federal government, other government bonds globally, so high quality end, combined with highly rated investment grade bonds. So that makes up the vast majority of the portfolio. The way in which the performance is driven for the portfolio is based on two things, which really are core to the way in which PIMCO approaches managing portfolios. First one is our macro top-down approach to building portfolios. So we will take views on whether we think interest rates will be cut and in what countries and at what pace, and that will factor into the way in which we construct the choice of the maturity of the bonds that go in. Secondly, we do have a bottom-up process that is combined with that, where we'll make decisions around sector, around currencies, and around the credit ratings of which bonds make it into that portfolio.
So are there any sectors at the moment or geographies that are really appealing at the moment?
So Australia is going to be, and will, I'm certain, in a longer run, be a very large part of the portfolio. At the moment, it's a meaningful size.
It's interesting that Australia is such a meaningful portion. Like, is that a reflection on like our credit quality? Like, are we good, or is it just because it's a Australian domiciled fund?
It's a little bit of both.
Okay.
And I think firstly, because we're looking to generate returns in Australian dollars, it's very important that we have an anchor of the portfolio that is based in Australian assets. But the second thing, which has been a really interesting opportunity set, has been around mortgage-based or RMBS, residential mortgage-backed securities. And what we've seen is this proliferation of non-bank mortgage lenders, which has created a really good opportunity for us as investors to buy into bonds that are attached to those mortgages. And that's a meaningful part of the allocation. And as I say, that's a big part, the bricks and mortar, are a big part of the Australian investment landscape.
We're obviously from the equities side of things, where the active versus passive debate is hot, but it feels like the active versus passive debate in fixed income, the data is a little clearer that active does outperform. It's not just you saying that, but give us a sense of what the data says, and I guess what's behind that data, what drives the outperformance.
The data does say that your average fixed income manager beats the benchmark. Now, it depends on which study you look at, but generally speaking, it ranges from around about 60 to 70%. And the opposite tends to be true in the equity market, where 60 to 70% underperform the benchmark. So for PIMCO, as at December 2025, across all of the assets that we manage, we beat the benchmark 93% of the time. And when compared to the average active fixed income manager, we beat other active fixed income managers 85% of the time.
Yeah.
So pretty impressive stats, both in terms of the overall industry, but also where PIMCO's real pedigree is within that industry.
So I'd love to drill into the mechanism of how the average fixed income manager is beating the benchmark. What is it that sort of allows the average manager to outperform?
So it is the construction of the indices, and that is that passive bond indices often overweight the most indebted issuers. And what that does is create a lot of opportunities for active managers to exploit inefficiencies. And those inefficiencies can be things like new issue premiums and also non-economic investors, which could be central banks or insurance companies where there's a rating limitation on what they can hold that can cause quite a large amount of inefficiency to occur within certain credit rating brackets. And that leads to persistent outperformance net of fees.
What are some of the key metrics or characteristics we should look for in an active manager when, I guess, comparing those that are consistently beating benchmark?
Breadth of platform and resources are a really big part of what goes into achieving that consistency of outperformance over a benchmark. It is one of those industries where having a platform that supports a large amount of research for the bottom up and one that is global by default and involved in many, many markets to be able to form those macro views that inform our positioning, that's what we think is important, has been a secret as to why we've been so consistently performing well.
Well, Sam, you said at the start that you wanted to make the case that we should be bond mates or fixed income friends. I reckon this is the point where we're going to get you to really make the case, because I feel like we're in an income moment in Australian investing. I think one of the most common questions we're getting from our audience is around passive income, and there's a real interest in passive income strategies. We've got ETF issuers like yourself coming with fixed income active ETFs, but we've also got more and more like high yield ETFs. We've got, there's like floating rate funds, there's Aussie focused funds, there's obviously this whole private credit conversation, which isn't so much in the ETF space, but like I just feel like income's having a real moment. So this is your chance to make the case why bonds are should be the income product of choice and why we should rebrand as bond mates. So with all the choice out there, why bonds?
So I think that the first comment I would make is really just to try and simply describe what is the ecosystem of the capital market, which is to say that at the higher end of the risk spectrum is equities. Then you have high yield, mezzanine, other things that live within that sort of middle point, a lot of which finds its way into the private credit funds. And then you have the investment grade bond part of the market and the government bond part of the market, which is typically seen as being not typically seen, it is the most stable and lowest risk part of the market. Now, the reason as to why I sit here today and tell you that that's an area of high conviction for PIMCO is because we see the risk premiums in those other two segments of the market becoming very, very tight. So when you look at the backdrop that we have today, and we joked a little bit before around even if we'd had a crystal ball and could have foreseen some of the things that have occurred since we last spoke 6 months ago, we wouldn't have expected the market to be where it is today. All-time highs, tighter spreads we've seen for many, many years. And all of that is a backdrop which is very uncertain. And so against that backdrop, where you can look at high-quality investment-grade bonds that start with a yield of 5 to 6% and then add the alpha element, which we would hope to push that further by another 1 to 1.5%, it's a pretty compelling backdrop and a pretty great place to be amongst all of the other alternatives that are out there. So that's really the case. We feel like it's a moment in time where risk is stretched and it makes a lot of sense to increase the allocation to a safer part of the market.
The other part of the income conversation that I forgot to mention before was this whole hybrids conversation and, the slow phasing out of hybrids. I think 2032 is the deadline. And so a lot of Aussie investors are also thinking about how they can find income replacements for hybrids. The PIMCO range of active ETFs, could they serve as a replacement for some of that hybrid income?
We've actually just published a note on exactly that, and it is available on our Australian website under the Insights tab. And some of the conclusions that come out of that paper that we've published is that a diversified fixed income portfolio can not only achieve something that replaces the return profile of a hybrid, but actually can do so in a way that delivers a superior risk-return outcome for investors. So I'll paraphrase, but there is more details that are available in the paper. But essentially what that suggests is that there would be around about 20% that would be sitting in something that we would describe as enhanced cash, very similar to the EARN ETF. There would be around about 40% sitting in core bonds. So that would be something like our PDFI ETF, which is a blend of half global, half Australian bond exposures. And then 10% in global credit, very similar to our PCRED ETF, and 10% into a global capital securities exposure, which is, think of that as being the global equivalent of a hybrid. And finally, an allocation of up to 20% in global private credit. So that's the summary of the paper, and all of that we believe can return the same amount of yield for a lower volatility or alternately a higher yield for the same volatility, as the paper concludes.
Well, Sam, we'll include a link to the paper for those that want to go deep in the show notes. But look, we have reached the end today. We really appreciate you coming in. Love that managers like PIMCO are making their strategies available to retail investors in an asset class that has traditionally been hard for us to access. So we appreciate it, and it was great to have you back on. Thank you so much.
Thank you both for having me.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful. Equity.